Three people bought almost the exact same house in 2026. Same city, same housing market, same economy, same inflated grocery prices making normal middle-class people stare at eggs like they were luxury imports now. Same job market, same interest rate environment, same financial system, completely different result. And the person who looked the most financially responsible in the beginning did not end up winning. That's the part nobody talks about when people argue about mortgages online, because the conversation usually sounds painfully simple. If you can afford the 15-year mortgage, take it. Lower interest rate, faster payoff, less interest paid to the bank, more equity, more discipline, more responsibility. The advice gets repeated so often that people stop treating it like an opinion and start treating it like objective truth. The 15-year mortgage became one of those financial ideas that automatically sounds intelligent the moment someone says it out loud, like meal prepping on Sundays, waking up at 5 a.m., or pretending anyone genuinely enjoys cold plunges. And honestly, the math looks convincing at first. That's why Ethan believed it. In early 2026, Ethan bought a house outside Denver for $460,000. Not some influencer mansion with a floating staircase and a kitchen larger than most apartments. Just a normal upper-middle-class American house, which in 2026 somehow still meant a monthly payment large enough to make people emotionally attached to direct deposit notifications. He put 20% down, leaving him with a loan balance of roughly $368,000. He chose the 15-year mortgage at 5.9%, and his monthly principal and interest payment landed around $3,090. After taxes, insurance, utilities, maintenance, and the endless hidden costs of homeownership nobody includes in YouTube thumbnails, the real housing cost felt closer to $3,700 every month. It was manageable. Barely. That's the thing about aggressive fixed payments. They usually don't destroy people dramatically. They slowly redesign behavior, one smaller decision at a time. Ethan stopped ordering delivery almost immediately because paying $38 for cold fries and a burger suddenly felt ridiculous when another $3,700 payment was waiting around the corner every month. Then came fewer weekend trips, fewer random Amazon purchases, fewer "we deserve this" dinners after work. Even normal spending started feeling suspicious. But for a while, Ethan genuinely believed he had cracked the system. Every month, the mortgage balance dropped aggressively. Thousands of dollars moved toward principal instead of interest. Watching the amortization schedule felt addictive because humans love visible progress. That's why paying off debt feels powerful. You can see the numbers shrinking. Investing feels invisible in comparison. Nobody opens a brokerage account after 6 months and feels transformed. But mortgage balances collapsing? That feels productive immediately. The shrinking balance made Ethan feel financially stronger every year. By year 8, the loan balance was falling so quickly that some of his friends started questioning their own mortgage decisions. Ethan looked disciplined, stable, organized. For a while, he genuinely looked like the smartest person in the room. And honestly, compared to many people in 2026, he probably was. Meanwhile, Ryan bought almost the exact same house 2 streets away. Same builder, same layout, same square footage, same inflated market where everyone complained homes were unaffordable while continuing to bid against each other anyway. Ryan and his wife earned roughly the same combined income as Ethan, around $150,000 before taxes. On paper, their financial lives looked nearly identical. But Ryan chose the 30-year mortgage instead. His rate was slightly higher at 6.5%, which immediately made finance people online react like he had personally insulted compound interest itself. His monthly principal and interest payment came out closer to $2,325. After taxes and insurance, the real housing cost landed around $2,950. The difference between Ethan and Ryan? Roughly $750 every month. That number quietly controls the entire story because financial outcomes are rarely destroyed by one catastrophic decision. Usually they're shaped by wherever the extra few $100s keeps going every month for 15 or 30 straight years. Ryan loved the flexibility almost immediately. Lower payment, more breathing room, more margin for life. And honestly, life in 2026 required margin because modern adulthood had quietly turned into permanent monthly extraction. Streaming subscriptions, i.e. subscriptions, cloud storage subscriptions, fitness apps, delivery memberships, car payments, insurance premiums, software upgrades. Even basic middle-class life now felt like a collection of recurring charges endlessly drafting from people's checking accounts. Cash flow mattered psychologically. A lot. Small emergencies stayed small. That changed everything. A car repair became annoying instead of destabilizing. A slower month at work didn't immediately trigger panic. Ryan slept better than Ethan within the first year, and that matters more than most people realize because financial pressure doesn't just affect numbers. It affects mood, relationships, energy, confidence, eventually identity itself. That's the real reason so many households feel stuck now. The middle class doesn't usually get destroyed by low income anymore. It gets destroyed by obligation density. Too many fixed payments. Too little room to breathe. But then there was Chloe. Chloe bought another house in the same area 6 months later. Similar price. Similar income level. Same 30-year structure Ryan chose. Similar payment. Similar interest rate environment. But Chloe approached the entire situation differently. She didn't see the mortgage emotionally. She saw it structurally. That sounds like a tiny distinction. It changes everything. Because Ethan optimized for debt reduction. Ryan optimized for flexibility. Chloe optimized for long-term capital growth. Those sound similar. They are not. The week Chloe closed on the house, she calculated the exact difference between her payment and what a 15-year mortgage would have cost. The number came out to roughly $760 every month. Then she automated it immediately. Every month, automatically, the day after her paycheck cleared, $760 transferred directly into a low-cost S&P 500 index fund. Same amount. Same day. No motivation required. No monthly decision-making. No, I'll invest whatever is left over. Because Chloe understood something most people don't. Nothing is ever left over. Life absorbs available cash with terrifying efficiency. That's why so many people fail with a 30-year and invest the different strategy. The math works beautifully. Human behavior usually doesn't. People imagine they'll invest the extra money consistently, but then reality happens. A vacation here, better furniture there, more restaurants because work has been stressful lately, a newer SUV because the monthly payment isn't even that different. None of it feels reckless individually. That's how lifestyle inflation works. It arrives disguised as normal life, slowly becoming more expensive. And this is exactly why the 15-year mortgage crowd sounds convincing, because they've watched millions of people become Ryan. People who genuinely intended to invest the difference, but never built a system strong enough to survive real life. The hidden truth underneath most financial advice is that the real battle usually isn't math versus math. It's math versus human behavior. And human behavior has a terrible long-term track record around available cash. That's why Ethan looked smarter in the beginning. His discipline was forced. Every extra dollar automatically went toward the mortgage whether he felt motivated or not. The system itself enforced the behavior. Meanwhile, Ryan depended entirely on future discipline, future consistency, future motivation. That almost never ends well. But Chloe built something different. She built a system that kept functioning even when motivation disappeared. And the difference started looking visible surprisingly fast. By year 3, Chloe's investment account had already grown to roughly $32,000, assuming average market returns around 8%. Nothing life-changing yet. Ethan still looked dramatically ahead because his mortgage balance had already dropped below roughly $315,000, while Ryan and Chloe still owed closer to $350,000. On paper, Ethan looked safer. Internally, he felt safer too. That matters because certainty itself has psychological value. Watching the debt balance collapse created constant reinforcement. Every extra payment felt like proof he was getting ahead, while everyone else stayed trapped in 30 years of interest payments. Finance podcasts reinforced it constantly. Friends admired it. His parents loved it. The strategy looked disciplined because it was disciplined. The problem is that discipline and optimization are not always the same thing. While Ethan spent Sunday mornings recalculating payoff timelines and checking amortization schedules, Chloe barely thought about the mortgage anymore. The transfer happened automatically. The investments kept buying automatically. The system kept functioning whether she felt motivated or not. That's what made Chloe dangerous financially. Her wealth-building process no longer depended on mood. By year 5, Ethan's remaining mortgage balance had fallen to roughly $278,000. Ryan still owed around $334,000. Chloe also still owed around $334,000. But Chloe's investment account had quietly crossed approximately $58,000. Liquid, accessible, still compounding. And that's where the comparison quietly starts changing, because Ethan's extra payments were aggressively reducing liabilities while Chloe's investments were aggressively building productive assets. Those are not the same thing. One creates visible certainty. The other creates scalable growth. Year 5 still looked small. Year 7 started looking interesting. Year 10 started looking uncomfortable. By year 10, the gap between them stopped feeling theoretical. Ethan's remaining mortgage balance had fallen to around $167,000. Chloe still owed roughly $291,000 on her house because she was following the standard 30-year schedule instead of aggressively attacking the balance every month. On paper, Ethan still looked dramatically ahead because he had built far more equity, far more ownership, and far more visible financial progress. The shrinking mortgage balance made him feel financially stronger every year. And honestly, compared to many people around him, he probably was. Ethan wasn't failing. He wasn't irresponsible. He wasn't financially reckless. For a long time, he genuinely believed he had cracked the system. Every extra payment felt like proof he was getting ahead, while everyone else stayed trapped in endless mortgage payments. Finance podcasts reinforced it constantly. Friends admired it. His parents loved it. But Chloe's investment account had quietly crossed roughly $148,000. And here's the part almost nobody processes correctly. By year 10, Chloe's portfolio alone was already larger than Ethan's entire lifetime interest savings from choosing the 15-year mortgage. That's the hidden math nobody talks about, because Ethan saved interest while Chloe built an entirely separate asset. Meanwhile, Ethan's wealth remained concentrated almost entirely inside home equity, and home equity creates a strange psychological illusion because people treat it like cash when it absolutely is not. Accessing home equity means refinancing, loans, HELOC approvals, paperwork, or selling the house completely. A paid-down house can make people look wealthy while leaving them surprisingly fragile during real emergencies. It looked responsible. It also quietly reduced flexibility. Then the economy slowed down. Not a complete collapse, just enough instability to make everyone uncomfortable. Layoffs increased. Hiring slowed. Companies started replacing raises with phrases like AI efficiency restructuring. Suddenly, LinkedIn became filled with people excited to announce a new chapter after losing jobs they thought were secure 3 weeks earlier. Every office worker in America developed a mild stress response every time a random meeting invitation appeared unexpectedly on their calendar. And this is where payment structures start changing real life. Ethan still had his job, but psychologically it barely mattered because aggressive fixed obligations create permanent low-grade pressure. Every rumor about layoffs felt personal. Every surprise expense became mentally connected to survival math. A transmission problem on the SUV suddenly wasn't just annoying anymore. It was destabilizing. Ethan started checking work emails later at night. He volunteered for projects he didn't even want because financially he no longer felt comfortable slowing down. Meanwhile, Chloe experienced the exact same economy differently. When layoffs started, Chloe adjusted. Ethan panicked. That's the real difference between liquidity and obligation. Chloe could survive uncertainty. Ethan could only survive consistency because his entire financial structure depended on income arriving perfectly on time every month. The irony was brutal. The closer Ethan got to financial freedom, the more psychologically trapped he sometimes felt because the system he built required constant performance. While Ethan refreshed mortgage calculators and tracked payoff timelines obsessively, Chloe barely opened her investment account anymore because the system itself handled the discipline automatically. Ethan tracked debt. Chloe tracked cash flow. Those sound similar. Over long periods of time, they become completely different financial lives. That difference became impossible to ignore by year 12 because compounding started accelerating psychologically. That's usually how compounding works. In the beginning, it looks almost disappointing. Year 1 feels small. Year 3 feels decent. Year 5 feels encouraging. Then somewhere around year 10 to 12, the curve changes emotionally. The growth stops looking linear and starts looking unfair. Chloe's investment account crossed roughly $215,000 even after multiple market pullbacks during the late 2020s because the money kept compounding regardless of recessions, elections, layoffs, interest rates, or whatever panic people were posting online that week. The system kept buying automatically through every market drop, while Ethan's extra cash flow kept disappearing into home equity. Then year 15 arrived, and this is where most people stop the comparison. Because year 15 is where Ethan finally achieved the dream everyone praises. His mortgage was gone completely. 15 years of aggressive payments. 15 years of sacrifice. 15 years of consistently prioritizing debt reduction over flexibility. And to be clear, Ethan accomplished something genuinely impressive. Assuming the house appreciated at a conservative 3% annually, the property was now worth roughly $717,000. Mortgage balance, 0. Ryan still owed around $248,000 on his mortgage. Chloe also still owed around $248,000. On paper, Ethan had won. The math disagreed. Because at the exact same moment Ethan celebrated becoming mortgage-free, Chloe's investment account had crossed roughly $325,000. Liquid, accessible, still compounding. That's where the comparison finally becomes uncomfortable because Ethan owned more of the house while Chloe owned far more productive capital. Ethan's strategy created visible certainty. Chloe's strategy created scalable wealth. And the difference between those outcomes becomes massive over long periods because money compounds differently depending on where it sits. Home equity mainly compounds through property appreciation. Broad market investments compound through business growth, dividends, productivity gains, inflation pass-through, and decades of reinvestment. Historically, those systems have not produced the same long-term returns. Meanwhile, Ryan stayed trapped in the middle, which is what made his situation so painfully realistic. Ryan wasn't reckless. He wasn't stupid. He simply did what most people do when money remains optional. Some years, he invested consistently. Other years, life absorbed the difference. A kitchen remodel. A newer SUV after the second child was born. More vacations because the kids are only young once. Better furniture. More convenience spending. Higher grocery bills from shopping at places where somehow every bag costs $140, even when there's barely any food inside it. Nothing individually looked destructive. That's why lifestyle inflation becomes so dangerous. It doesn't feel like failure while it's happening. It feels like normal adulthood slowly becoming more expensive. By year 15, Ryan's investment accounts held less than $70,000 despite having similar income and similar housing costs overall. That's what makes the 30-year and invest the difference strategy so misunderstood online. The math itself is incredibly powerful. Human execution usually isn't. Most people don't fail financially because the strategy was wrong. They fail because the system depended too heavily on future discipline that never consistently arrived. Ethan succeeded behaviorally because discipline was forced. Ryan underperformed because discipline remained optional. Chloe won because she automated the behavior and removed emotion from the process entirely. And this is where compounding stops looking impressive and starts looking unfair. The first 15 years built the system. The next 15 years exposed what the system actually was. From year 15 to year 30, Ethan no longer had a mortgage payment, which genuinely felt amazing. Suddenly, he had thousands of dollars of monthly cash flow available again. For the first time in over a decade, his financial life felt lighter. But Chloe still had something Ethan didn't fully appreciate yet: momentum. Her earlier investments were already compounding on top of themselves, while she continued adding new money every month. That's where the curve starts becoming violent mathematically, because compounding rewards time more aggressively than intensity. By year 30, Ethan's paid-off house had appreciated to roughly $1 million, assuming long-term 3% annual appreciation. Once he became mortgage-free, he also started investing aggressively. And after 15 additional years of investing the old mortgage payment, his portfolio reached approximately $820,000. Combined net worth, roughly $1.82 million. Impressive. Very impressive. But Chloe's numbers looked completely different because her money had 30 years of uninterrupted compounding instead of 15. Her home reached the same approximate $1 million valuation because it was the same housing market. Her mortgage was also completely paid off by year 30. But her investment accounts had grown to roughly $1.55 million. Total net worth, approximately $2.55 million. Difference between Ethan and Chloe? Roughly $730,000. And that's the hidden reveal almost nobody talks about when discussing 15-year mortgages, because the emotionally responsible choice quietly became the lower return path. Ethan spent 15 years optimizing for certainty. Chloe spent those same years optimizing for compounding. Over 30 years, those became completely different lives. The financial system did not reward the person who sacrificed more. It rewarded the person whose capital stayed alive longer. Ethan built financial endurance. Chloe built financial momentum. Those are not the same thing. Reality always arrives eventually. Layoffs happen. Burnout happens. Medical bills happen. Industries collapse. Careers change. Kids become expensive. The system has to survive anyway. That's why Chloe ultimately won. Not because she was smarter. Not because she worked harder. Not because she suffered more. She won because she built a financial structure that kept compounding automatically for 30 straight years without requiring constant emotional effort. The system rewarded the person whose money stayed invested longer, not the person who suffered harder.